Okay, Bismillahirrahmanirrahim and Assalamu alaikum to everyone and good day also. We are starting our financial management crash course for March 2024. Just let me tell you a few things, then we are starting. Let me admit all of them. They are joining. To be very honest, if any one of you has not started preparing yet for FM, if you just go through the entire crash course, you can easily pass this paper. But you have to be committed to go through all the crash course, each and everything which I'm going to teach you, inshallah, today as well as in next 4 days. So to be very honest, it's going to be the journey with me, inshallah, is going to be really good. So let's start without further any delay. We are starting directly from investment appraisal. Investment appraisal is approximately 40% of your syllabus. Investment appraisal is approximately 40% of your syllabus. Let me first write the topics, what we are going to cover in investment appraisal. Because when you will be preparing yourself, you should be having that checklist, which I'm going to just write it down here. Number one, the topic which we are starting is investment appraisal. Number one topic is NPV. Second, IRR. Third, payback period, both simple payback as well as discounted payback. Fourth is accounting rate of return. But most of the time, our examiner, instead of asking you to calculate accounting rate of return, he uses the term word ROC, return on capital employed. So you should not be worried about that. Fifth, sensitivity analysis. Six, lease or buy decision. Seven, asset replacement decision. Asset replacement decision. 8, capital rationing. 9, expected value of NPV. So basically, when you are preparing yourself for the topic investment appraisal, you have to go through at least these 9 topics. Any other topic, if it is in your mind, you can definitely tell us. Otherwise, these are the major areas in your investment appraisal. Okay. So we'll make sure that we have to go through all these 9 topics. So, dear student, please, your mic and camera should be off. Only my camera is enough, please. Thank you. So I would request to switch off your camera, please, if any student has opened the camera. Please, I think there's Anas. Anas, can you please switch off your camera? I don't think so that Anas is not. Anas, am I audible to you? Then whose camera is on? There's Tufel, maybe. Okay, whoever has opened the camera, please just check your camera. Thank you. Okay, students, let's start investment. These are the topics, okay? Make sure that we have to go through all these topics. We're starting from NPV, net present value. What is the actually interpretation of NPV? What is the interpretation of NPV? We'll come to that. But before coming to the interpretation of NPV, let us first start from the basic. So, Tufail, please turn off the camera. That's a bit disturbing. I don't know why it is open again and again. Tufail, please. I have no idea. Okay, let's just start the basically principles of NPV. Number one, I would request again, Tufail, please, can you turn off your camera? Can anyone tell the Tufail if it is Tufail's camera? Yeah, that's, I don't know why it is happening. Okay, let's see. Okay, fine. Okay, now student, please listen. Let's start the basic principles of NPV. Number one, when we are calculating NPV, we always work on relevant cash flows. Repeat. When we are calculating NPV, we always work on relevant cash flows. So the first concept is when we are calculating NPV, we always work on relevant cash flows. The principle number one is while calculating NPV, we consider which cash flows? Relevant cash flows. Now listen and listen carefully. Now you have to develop a really good understanding of relevant cash flows. Now the entire discussion will be on relevant cash flows. I'm going to start from very basic and then we'll go till our examination level. In fact, little bit higher than examination level. You have to sit with the patience and time. Okay, you have to give me the time. So yes, the first thing which you need to learn is while calculating NPV, the entire focus will be on relevant cash flows. Now, what do you mean by relevant cash flows? Number one point. Relating, now we are discussing everything regarding relevant cash flows. Number one. Either when we talk about relevant cash flows, it means future cost. Basically, the future cost is relevant. For example, if I talk about initial investment is the amount which you have not invested yet. So basically, the future cost is relevant. The cost which is still to be incurred, it is relevant. Similarly, the future earnings are relevant. So the future cost is relevant. The cost is still to be incurred. Is relevant. Now listen. If I talk about feasibility study cost is not a future cost. This is the cost which you have incurred before starting the project. That is why we say such cost is irrelevant. Right now, just focus only on one point. That is future cost is relevant. Second, those benefits are relevant which you are going to earn in the future. For example, when I'm going to make investment in this project, that in the future I'm going to have sales. In the future, I'm going to have, let's say, scrap value. So those earnings are relevant, which they relate to the project and you are going to earn in the futures. So when it comes to earnings yet to be earned. Third, either it is an inflow or outflow. It must be caused by the project. Repeat, either it is an inflow or an outflow. It must be caused by the project. So caused by the project. Actually, caused by the project. Examples, for example, incremental cash flows. For example, incremental cash flows. Another example could be opportunity cost. So either it is an inflow or outflow, it must be caused by the project. The fourth rule is extremely important. By definition, it must be a cash flow. What did I say? By definition, it must be a cash flow except tax depreciation. Repeat. By definition, it must be a cash flow except tax depreciation. Now the question arises, why except tax depreciation? I'll come to that. But let me write this. By definition, must be a cash flow. I'm coming to this. By definition, must be a cash flow except tax depreciation. Another name for the tax depreciation is capital allowances. What I've written in point number 3, actually I said either you are having inflows or outflows in the project, they must be caused by the project. Because of the project, those cash flows are either there are inflows or outflows. That is point number 3. Caused by the projects. For example, like incremental cash flows. For example, you are suffering an opportunity cost because of the project. That is why that opportunity cost is relevant for you. So by definition must be a cash flow, but except tax depreciation. Now the question arises, sir, why the tax depreciation is an exception? Now listen. Tax depreciation itself, it is not a cash outflow, but due to tax depreciation, entity, organization, they are going to save tax. That is why we do consider tax depreciation while calculating NPV. Repeat. What did I say? By definition, it must be a cash flow, except exception is the tax depreciation. Tax depreciation itself, it is not a cash flow, but due to tax depreciation, due to capital allowances, what are we going to do? We are going to save the tax. That is why we consider it. Yeah, I will share this. Don't worry at all. These notes will be shared. Don't worry at all. Make sure that every one of you must be in my financial management group. So I will share these notes. Don't worry at all. Okay. Now next point. Please listen. I said by definition, it must be a cash flow except as the tax depreciation. Now, another very important point. Try to understand. Let's say you are calculating NPV, okay? An examiner has given you the assuming interest payments, dividend payments. Now listen and listen carefully. Interest payments, dividend payments, these are the payments to the provider of finance. Their impact is already considered in cost of capital. That is why while calculating NPV, we do not take them as relevant cash flows. Why? If you do that, then there will be a double counting. Interest payment and dividend impact is already there in the cost of capital. If you consider that into your NPV calculation as well, so there will be double counting. So to ignore that double counting, we do not consider interest and dividend payments as relevant cash flows because their effect is already incorporated into the cost of capital. So while calculating NPV, interest and dividend payments are not considered as relevant cash flows because their effect is already incorporated to cost of capital. Incorporated in cost of capital. Okay, next point. Past cost is irrelevant because past cost is sunk cost. Past cost, sunk cost is irrelevant. Actually, the cost which you have incurred in the past, whatever decision you are going to make today, it will not affect the past cost. So whatever happened in the past, it has happened. I always give one message to my students. Please, whatever has happened with you in the past, either good or bad, please don't live in the past. Stay in the present, focus on the future. Don't live in the past, stay in the present, focus on the future. So the main thing is past costs. For example, let's say before starting the project, company has incurred R&D before starting the project. So the cost of R&D which company has incurred before starting the project, that is a sunk cost. But listen, if the question says after making an investment, you have to carry out R&D, then R&D is relevant. Repeat. If the question says after making an investment, you have to incur R&D, then R&D is relevant. But if you have incurred R&D before starting the project, then it is irrelevant. Okay, there could be a one trap by the examiner. Listen. Let's say the examiner says APLC has incurred R&D before starting the project. The amount is $1 million, but this 1 million will be paid after 1 year, after, let's say it will be paid after 2 years of the project. Now listen and listen carefully. You have actually carried out the R&D before starting the project. Now either you will be making the payment after 2 years, after 3 years, that is irrelevant. Why? Because you have to make the payment. And that is sunk cost. It is not relevant at all. Because before starting the project, you have incurred that thing. Only you have not made the payment. So since R&D was incurred before starting the project, that is why it is irrelevant. It is your past cost, sunk cost. Another point, existing overheads are irrelevant. Now the question arises, existing fixed overheads. Why existing fixed overheads are irrelevant? Because your existing fixed overheads are not incremental. Repeat, existing fixed overheads are irrelevant. Why they are irrelevant? Because they are not incremental. Existing fixed overheads are irrelevant because they are not incremental. Now listen and listen carefully. For existing fixed overhead, examiner can use number of terms because there are rare chances that for existing fixed overhead, examiner is going to use the word existing. If he is using the word existing, then it becomes quite obvious nobody is going to take it while solving the question. What are the possible terms which examiner can use for existing fixed overheads? Let me introduce all of those terms with you. What I'm going to write right now, terms for existing fixed overheads. Number one, allocated overheads. B, apportioned overheads. Apportion. Third, Absorb overheads. Sir, it is possible to take R&D when investment. I think I have already cleared this point. If the question says that after making an investment, you have to incur R&D, then R&D becomes relevant. So absorbed overhead is that point. So simple concept was if the R&D was incurred before starting the project, irrelevant. If R&D is incurred after starting the project, then it is relevant. Then it becomes the part and parcel of that project. Third is absorbed overhead. Fourth, applied overheads. Fifth one is very important. ABC allocation. Now listen and listen carefully. Activity-based costing allocation. Actually, what is the major difference between absorption costing and ABC costing? Actually, under absorption costing, ABC says that the allocation of overheads is unfair. And ABC says we tell you the true fair allocation of overheads. But when it comes to the total overheads, either you are using absorption costing or you are using, let's say, ABC costing, your total overheads will remain same. So these are the 5 terms. Any one of them could be used for existing overheads. Okay. Even examiner says ABC activity-based allocation irrelevant. Now, another point. Point number 8. So far, what we actually are discussing till here, we have discussed what are the relevant cash flows, what are the irrelevant cash flows. One more irrelevant cash flow. What is that? That is committed fixed cost is irrelevant. Committed fixed cost is irrelevant. Let me give you the example of committed fixed cost. The example of committed fixed cost is, for example, a business premises which is already on rent. What did I say? A business premises which is already on rent. It means you will be paying rent in the present as well as in the future. But since the business premises is already on rent, and let's say you can accommodate the new project in that premises, which means that either the new project is accommodated into that premises or not, still you have to pay the rent. So that is an example of committed fixed cost, which is irrelevant. Okay. Now let's take one step ahead from this relevant and irrelevant area. Let's introduce another important rule of calculating. What are we discussing right now? We're just discussing the basic principle of calculating NPV. Now, the first, all the 8 points you can say they relate to relevant, irrelevant cash flows. Now, let me introduce another concept, basic principle of calculating NPV, extremely important. I would not say only important, I'm just telling you extremely important. That is cash flows. Actually, when you are calculating NPV, you should know one thing. There are 2 types of cash flows. One is real cash flow, another is nominal cash flow. Second name for the nominal cash flow is monetary cash flow. Third name for the monetary cash flow, nominal cash flow is money cash flow. So actually there are 2 types of cash flows. One is real cash flow, another is nominal. There are few other terms for the nominal. It could be examiner can use a monetary, another word which is possible for the nominal cash flow is money cash flow. Real cash flows means without inflation. Nominal means with inflation. So real means without inflation, nominal means with inflation. Now listen. If you have been given, let's say, real cash flows, for calculating present value of real cash flows, you have to use real WACC, real weighted average cost of capital, real cost of capital. If you have nominal cash flows, then you will be using nominal WACC. Repeat. For real cash flows, discounting, you will be using real cost of capital. For nominal cash flows, discounting, you will be using nominal cost of capital. Now you need to learn two things. One, how to convert real cash flows to nominal. Then we'll also be learning, inshallah, how to calculate nominal cash flows to real. Then you need to learn, if you have been given, let's say, a real cost of capital, but you need nominal. How do we convert real cost of capital to nominal or nominal to real? Number one, we are learning number one thing. Conversion of real cash flows to nominal, extremely important. Real cash flows to nominal cash flows. Means you have been given real cash flows without inflation and you have to incorporate the impact of inflation. Now, what are the rules for converting real cash flows to nominal? Okay. Now, all the rules, they relate to how do we convert real cash flows to nominal? Number 8. If your examiner says the given prices are current prices, listen. If you have been given current price, another possible term is year zero price. Another possibility is real term price. Another possibility is present day price. All mean the one thing, price at time zero. If you have been given a price at time zero, then you have to incorporate inflation from the first year. Inflation comes from first year. If examiner gives you the first year price, actually first year price means including with the first year inflation. So that is why you have to incorporate inflation from the second year. So if first year prices are given, then you have to incorporate inflation from the second year. If you have been given first year price, then inflation comes from the second year. Now this is very important, okay? Sometimes students, they do make mistake in this area also, but I hope you people will not be making, inshallah. I really want every one of you try to use your calculators. Let's say T1, T2, T3, and let's take T4. Current price. We know that current price means price at time zero. Let's say the current price is 100, 100, 100, and 100. Inflation per annum is, let's say, 10%. And we just need to calculate nominal price. So you have been given real term prices. You just need to convert that into nominal price. So what I'm going to do, can I say simply I'm going to multiply this with 1.1. I'll get 110. Then 1.1 is squared. Or either you can multiply 1.1 with 110. It's up to you. I'm getting 121. Just a minute. Okay, what about this? 1.1 power 3. I'm getting 133.1. 146.41. But the second one, which I'm going to just give you, I want second one that everybody should try this. T1, T2, T3, T4. Average current price. Let's say 100, 122.5, 115.5, 130. Inflation per annum is 12%. I need nominal prices. So can you all quickly calculate nominal prices? What are the nominal prices for each year? Nominal prices for each year. What are we going to do? 112. Now it will be 1.12 power 2. I'm getting 153.664. I'm getting 162 point, make it 27. Please, other students also keep calculating. So in case of any error, we can correct it. So 130. I'm getting 204.55. Okay. Now here comes the third and the last variety. And let's see who will give the answer to this variety number 3. Now, for variety number 3, I will definitely give you the time. So that, let's see, what is your answer? Average current price. 100, 120, 118, 124.5. Inflation per annum. That is 10%, 15, 13, and 12. Nominal price. Please, I really want every one of you to attempt this question. I really want to see the answer in the chat box. So please, your time starts now. Please, every one of you should try this question and give me the answer. You can share your answer in the chat box. Let's see who is going to be the first one to answer this small question, or we have started getting answers. No. Complete 4, just not one. One, everybody knows the one. Okay, students are answering 110, 14. Okay, what about other students, please? What about others? Everyone is getting the same results or different? So far, 2 students have shared the answer. Please, other students do participate. There is no issue at all. So look at this answer. Answers are coming, and now everyone can see that answers are not only coming, they're coming, different answers are coming. Now we can see the variety in the answers. So anyone else, so that before I start solving? So now answers are there with the variety. Similar and the variety. Okay, that's great. Look at this. First one is obviously everyone is having the same answer, 110. A very important point is T2. Listen, in T2, what are you going to do? You will take 1.1 then into 1.15. You cannot go for 1.15 square. Why? Because 15% is the inflation only in second year. In the first year, the inflation was not 15, it was 10. So you cannot go for power 2. Let's see. 120, 1.1, 1.15. I'm getting 151.8. For the third year, what I'm going to do? 1.1, 1.15, then 1.13. Let's see what are the results. I'm getting 168.6751, 1.1, 1.15, 1.13, and 1.12. I'll also give the reason why we are not putting power over here. 199.32. Let's see who was having the same results. Chat box is here. Discount factors? From where you are getting the... Why everyone was having different answers? Waha, we are just incorporating inflation to the cash flows. What about this discounting? Okay, now listen. Now, dear students, see, this is the area where students start making a little bit mistakes. What the main question is why we are not taking powers over here. Now listen. And over here, look at this first year. 12, then there was a square, then power 3, power 4. Why the powers are coming here and they're not coming here? There's a reason. If you go back to your schooling time, every one of you have definitely studied. If I multiply x with x with x, when the bases are same, then we add the power. It will become x cube. Look at this. Bases are same. But when bases are different, please, some of the student while sitting in exam, they start thinking like this. Okay, from 15, it is coming to 13. So there's a deflation. Oh my God. There's no such thing. Please, 13% means now in the third year, inflation is 13%. So what are you going to do? The concept which you have to use over here is x multiplied by y is going to be x and y. There will not be any x square or y square. Is this clear to everyone right now? Extremely important variety. Variety number 3 is extremely important. Majority, they make mistake in this area. Please, you don't, because we love maths. Simply when inflations are changing, then you have to use, look at this. Okay, just student, tell me one thing. What if instead of 15%, what if there were 10%? What you would have done? You people would have done this, yes or no? If it was 10 in the second year also, am I right? Now it is not 10, it is 15. Take 10% of first year and 15% of the second year. It is like this, x multiplied by y is going to be x and y. You cannot put the powers. Why the power were coming over here? Because the bases were same in the first two questions. Is this clear to everyone now? Question 3, clear? Yes, no? Clear, that's great. Okay. Now let's start another point. If you have been given real cost of capital, how do we convert real cost of capital to nominal? And then how do we convert nominal to real? By using Fisher effect. By using Fisher effect, you can convert real cost of capital to the nominal or nominal to the real. Okay, I have a question. Nominal means, can I say with inflation? Real means without inflation. Now try to understand the equation. Nominal means with inflation. Real means without inflation. It means if we incorporate inflation to the real rate, then it should become nominal. Repeat. Nominal means with inflation. Real means without inflation. It means if we incorporate inflation rate to the real rate, then it becomes nominal. Look at the equation. 1 plus nominal rate is equal to very logical formula. 1 plus nominal is equal to 1 plus real rate. And look at this. I'm multiplying inflation with the real rate. 1 plus inflation rate. Real is without inflation, nominal is with inflation. So we're incorporating inflation to the real rate, so it becomes nominal. Now listen. Fisher effect. Okay. Okay, just quick question. You will be saying yes or no, okay? But within few seconds, don't take much time. Is there anyone who remembers the formula of international Fisher effect? Repeat. Is there anyone who remembers the formula of Fisher international effect? Yes, no. Okay, don't worry at all. Towards the end of the course, we will also study, inshallah, Fisher international effect formula. Don't forget this, okay? Now, inflation rate. The first question is, sir, which inflation rate we are using in Fisher effect? Now listen and listen carefully. In Fisher effect, we are not using specific inflation. Repeat. In Fisher effect, we are not using specific inflation. Another question is, what do you mean by specific inflation? I'll come to this. In Fisher effect, we use journal inflation. Which inflation do we use? We use journal inflation. Now the question is, what do you mean by specific inflation and journal inflation? Listen, examples of specific inflation. If your examiner says that selling price will increase by 10%, let's say variable cost will rise by 5%. Let's say additional fixed cost is relevant, incremental fixed cost is relevant. If your examiner says additional fixed cost will increase by 12%, these all three are the examples of specific inflation. General inflation means simply what is the inflation rate in the overall economy. So you're not going to use specific inflation over here. You'll be using general inflation and it will be given to you. Now, look at the question and I really want quick answers, okay? Real rate is 12%. Inflation rate is 8%. Please quickly, I need nominal rate. What is the answer? What is the, okay, we have the answers. That's great, 20.96. That is quick and better. So simply 1.12 into 1.08 minus 1, whatever comes, multiply that with 100. So 20.96. Other students also, if they have different answers, so you can tell us. Otherwise, the majority, yes, is perfect. 20.96. Great. Let's say nominal rate is 12%. Nominal rate is 12, inflation rate is 4. I need real rate quickly. That's great. Nice. 7.69. Let's see. Great. Okay, now dear student, try to understand how you people are calculating real rate. That is very important. Because within next 2 to 3 minutes, I'm going to give you extremely important concepts, inshallah. Let me write the relationship which you people have used. The real rate is equal to 1 plus nominal rate divided by 1 plus inflation rate minus 1. This is what you people are using. Great. So 1.12, 1.04 minus 1. What was that? 7.69. Obviously, the correct answer, 7.69%. Please concentrate. How did you convert the nominal rate into real? 1 plus nominal rate divided by 1 plus inflation rate and then minus 1. Don't forget this. Just after a few minutes, we are going to use it. Now, come over here. If you have real cash flows, you should be using real cost of capital. If you have nominal money, monetary cash flows, then you should be using nominal back. Please be careful. We are going to prove something. So you have to be very alert. Okay. Look at the example. Just an example. Let's say T1, the first year, T2 is the second year, cash flows. Taking 100 and 200. Let's say discount factor, the cost of capital is 10%. So in the first year, it is 0.909. Second year, it's 0.826. Present value of cash flows, 90.9. I think 165.2. Let me check the calculator. Yes, perfect. Now listen. Keep watching. Extremely important point is just about to come. Cash flow is 100 and 200. Okay. Now I want you to incorporate 5% inflation into that. So 1.05, 1.05 square. It becomes 105 and 200 into 1.05 squared, 220.5. So can I say now we have, great. Now we have nominal cash flows. Why I'm saying these are nominal cash flows? Once you have incorporated inflation to the cash flow, they will become nominal. Once you have incorporated inflation to the cash flows, they will become nominal. Okay. Now listen and listen carefully. It means that, let me change the color. It means that they're the real cash flows. Because I took the same cash flows and I just told you guys to incorporate inflation 5% per annum. So you have made real cash flows, you have converted to the nominal cash flows, which means that if they are real cash flows, can I say then this discount factor cost of capital is also real? Since now you have converted real cash flows to nominal, so can I say now we need to discount nominal cash flows by using nominal discount factor? Yes or no? If we have converted real cash flows to the nominal cash flows. Yes. If we have converted real cash flows to the nominal cash flows, so we'll be using nominal discount factor. Now listen, we only have 5% inflation, nothing else. Real cost of capital is 10%. If I make it nominal, nominal discount factor will be 15.5%. You people can use the Fisher effect. You will be getting the same result. How did I get this nominal discount factor? Real is 10% into 1.05, which is inflation minus 1. So it will be 15.5 if I'm not wrong. So it is. Now I need to calculate the discount factor of first year and second year. How do we calculate discount factor for the first year? 1.155 minus 1. Let's see. What is the discount factor for the first year? I'm getting 0.865, make it 8. Great. 0.8658 or 65. You were correct. Minus 2. 0.7496. Now let's multiply. Let's see what magic is going to happen. I'm getting 90.9. I'm getting 165.2. Please, students, try to understand. Look at this present values. We are getting the same results. Now listen the concept, extremely important concept I'm going to tell you. Extremely important. If there is only a single inflation rate in the entire question, if there is only a single inflation rate in the entire question, which is affecting the cash flows and the cost of capital, then it makes no difference on your NPV. Either you are calculating in real terms or in nominal terms. Repeat. If there's a single inflation rate in the entire question, which is affecting your cash flows and obviously cost of capital as well, then it will have no effect. Either you are calculating NPV, you are calculating present value, either you are calculating present value of the real cash flows or nominal, you will have the same result. It means that if somebody asks you a question, listen and listen carefully. When it is necessary to calculate NPV in nominal terms, when it is necessary to calculate NPV in nominal terms, when you have more than one inflation rates, logically, when you have more than one inflation rates, then you have to work in nominal terms, because when you have more than one inflation rate, in that case, NPV in nominal terms and NPV in real terms will not be comparable. For example, what if the inflation rate in the second year was, instead of 5, it was 6%? So you wouldn't be having the same present value in real and nominal terms. So if somebody asks you a question, when it is necessary to calculate NPV in nominal terms, the answer is when there are more than one inflation rates. The way back one question came, it came in FM as well as in AFM. Some junior accountant, what he did, he calculated NPV, and while calculating NPV, he ignored number of inflation rates. And then he said that since I ignored all the inflation rates, so that is why I work on real cash flows. I took real cost of capital, so my NPV is correct. No, absolutely wrong. When there are more than one inflation rate, then you have to work in nominal terms. You cannot ignore the inflation. So I think this concept is now clear to everyone. When it is more than one inflation rate, then you have to work in nominal terms. Okay, now let's come back here. Look at this, please. Why I'm mentioning this concept again and again? How did you calculate real rate? There's a reason for that. What is the reason? Actually, 1 plus nominal, we are dividing with 1 plus inflation. Now listen. And which inflation is this? Journal. Please try to understand. If your examiner says, these are the nominal cash flows, just an example, okay? Let's say 100, 120, 125, and let's say 112. What examiner is saying? Examiner is saying these are the nominal cash flows. Okay. An examiner is saying that a real cost of capital is 10%. And journal inflation rate is, let's say, 2%. A very simple question you have been given. Examiner has categorically clearly mentioned that given cash flows are nominal. Second, he has given you the real cost of capital, which is 10%. He has given you the inflation rate, 2%. Okay. And he has also mentioned that he has used different inflation rates to make them nominal. Okay. So actually now, examiner wants you to calculate NPV, but calculate NPV in real terms. So how to convert nominal cash flow to real cash flow? The first thing which we did discuss, that was how to convert real cash flows to nominal. Now, what are we discussing? How to convert nominal cash flow to real. So all you need is T1, T2, T3, T4. Nominal cash flows are 100, 120, 125, and 112. We need to convert them into real. I will divide this with 1.02. This will be divided by 1.02, the power 2, power 3, power 4. Now you will have real cash flows. Nominal cash flows divided by the inflation. If it is the first year, then simply 1.02. If it is the second year, then take power 2. So we are having answers. That's, thank you very much, 90.9. What is the second answer? Okay, 120. It's not 90.9, it's something else. 100 divided by 1.02, I'm getting 98. Maybe I saw something different. Okay, it's a previous question. Okay, 120 divided by 1.02 power 2, 115.3. That's great. What is the answer for the third one? 117.79. Okay. Now you can use the discount factor, which is 10% to calculate present value. 0.909, 0.826, 0.751, and 0.683. All you need is just multiply, you will have the present values. All you need is just multiply, you will get the present values. Okay. So now you should be having a really good idea how to convert real cash flows to nominal. If the examiner gives you the nominal cash flows and he's asking convert them into real, now you have a really good idea. No, 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 no. Please. By multiplying, we are converting nominal cash flows to real. Look at this. When you converted nominal rate to real, did you multiply or divide? What you did over here? When you convert real cash flows to nominal, then we multiply. But when you are converting nominal cash flow to real, then we divide. Is that clear? There was a question. Is it clear now? I have multiplied. Where I have multiplied? Let's see. Where's the multiplication? Where did I multiply? These all are divisions. One zero two. Yes. So 100 divided by 1.02, you will get 98. That is a real cash flow. Then I multiply this with a real discount factor, which is 10%. So you will have the present value. Is it clear? Yes or no? 98 into 0.909. That will be 89. So let me write this 115.3 into 0.826. 95.2378. What is the third one? 103.47. $88.64. Okay. Now let's discuss one more concept. Obviously, another principle of NPV. Basically, when an organization makes investment in any project, normally you will not be making investment only in non-current assets. You have to make investment in working capital as well. If you're not making investment in working capital, then operations will not start. The simple meaning of the working capital is current asset minus current liabilities. They will give you working capital. And we are going to study, inshallah, the entire working capital management as well, inshallah. Don't worry at all. What I want to say, when we are going to make an investment in any project, so it will not be the investment only in non-current asset. We have to make investment in working capital as well. Regarding working capital, we have one concept. The name of the concept is working capital can never be consumed. So whatever you are investing in working capital, it will be recovered at the end of the project. So simply, we are studying working capital Yeah, you can go for namaz because my asr time, I still have a time. After exactly, inshallah, 50, no, you don't miss the namaz, please. After 50 minutes, I'll give the break. So you can come back in 10 minutes. We'll be at basics. So, Hamad, you are right now in which country where Fajr timings? You are in which country, Hamad, right now? Yes. Canada. Okay, that's great, Hamad. Must be very cold as well. So you pray namaz. We'll be just discussing basics. Don't worry at all. So after 50 minutes, I'll give the break of my Asr namaz. So it will go on like this. Okay, we are discussing the concept. The name of the concept is working capital can never be consumed. Working capital can never be consumed. Now, what is the meaning of this? Working capital can never be consumed. Let me tell you. There are two possibilities. What is the meaning of working capital can never be consumed means whatever you are investing in working capital, at the end of the project, it will be recovered. Whatever you are investing in working capital, at the end of the project, it will be recovered. Okay. Now there are two possibilities regarding working capital. One, the working capital requirement could be constant. Second, the working capital requirement can be changing. If the working capital requirement is constant, then how do we deal with that? Second, if the working capital requirement is changing, how do we deal? Let me tell you both the examples. Number one, I'm dealing with when the working capital requirement is constant. Assuming the project is having a life for 4 years. So I'm just writing working capital and recovery. Assuming we are investing 100 in the working capital and the requirement is constant throughout the project, there will be no more investment except this initial 100. So entire 100 will be recovered. Example A means working capital requirement is constant. Second example. This is more important, okay? And you have to please concentrate on the wordings as well. Let's say the examiner says at the start of T1, working capital required. Let's say the examiner says at the start of T1, you have to invest 1,000 in working capital. At the start of T2, the investment is going to be 1,500. At the start of T3, the investment is going to be, let's say, 2,000. At the start of T4, the investment will be, let's say, 2,200. Repeat. This is the question. An examiner says at the start of T1, the investment in working capital will be 1,000, and then at start of T2, it will be 1,500. Start of T3, it will be 2,000. So how do we deal? Now, working capital requirements are not constant in second example, they are changing. So you have to work on incremental working capital. When examiner says at the start of T1, we are making investment of 1,000. Now listen, and listen carefully. While calculating NPV, in the same year, you cannot show the cash flow of January and the December. So while calculating NPV, we normally make an assumption that all the cash flows, they are incurred at the end of the year. So which means that when examiner says at the start of T1, you have to make investment of 1,000. So we'll show this investment at T0. Now, at the start of T2, you have to make an investment of 1,500, but you have already invested 1,000. It means incremental additional investment which is required, it is just 500. To reach at 2,000, you have to make additional investment of only 500. Why? Because you have already invested 1,500. To reach at 2,200, you have to just make additional investment of 200 because you have already made 2,000. Since working capital can never be consumed, so incremental working capital and recovery. So whatever you have invested, it will be recovered at the end of the project. So there are two possibilities regarding working capital. Either the requirement will be constant or requirement could be changing. Now let me give you one variety into that. What is that variety? It is not necessary the requirement is always increasing. There's a possibility requirement could decrease as well. Working capital required. Let's say the examiner says at the start of T1, you have to make investment of 1,000. At the start of T2, you have to make investment of 2,200. At the start of T3, examiner says you have to make investment of 1,500. At the start of T4, he says make an investment of 1,800. Okay. Now, how to deal with that? Now, again, incremental working capital. and recovery. For T1, you have to make investment at T0. You have already invested 1,000. To reach at 2,200, how much you will be investing more? 1,200. You can see the requirement is increasing, but now, a very important point. From 2,200, you're going down to 1,500. Now, requirement is not increasing, it is decreasing. So, since the requirement is not increasing, it has decreased. So, instead of outflow, there will be an inflow of 700. Is that clear to everyone? Because from 2,200, you are going towards 1,500. Now, requirement is actually not increasing, it has decreased. So, instead of outflow, there will be an inflow. Now, from 1,500, we are going towards 1,800. So, again, additional 300. And since we know that working capital can never be consumed, so at the end of the project, whatever you have invested in a working capital, it will be recovered. So, entire 1,800 will be recovered because the total has to be the sum of all these working capital must be 0. Is this clear to everyone? Because there is a possibility that working capital requirement can decrease also, not necessary that it is increasing. I hope it is clear. You can write the answer in your chat box. Okay, repeat. Yes, I can do that. See, examiner was saying at the start of T1, you have to make investment of 1,000. So we need 1,000 at the start of T1. For T1, actually, you have to make investment at T0. So we invested 1,000. From 1,000, you are reaching to 2,200. So there is an increase of 1,200. But look at this, from 1,200. When the requirement was increasing, we showed as outflow, as an outflow. Now from 2,200, we are going towards 1,500. Requirement is not increasing, it has decreased than inflow. Is that, look at this, T1 and T2, difference. Then from T3 to T4, requirement has increased. What I've written? Outflow. Then how did I get 1,800? If you do the if you just use a sum formula, you will be getting negative 1,800. Negative 1,800 means entire 1,800 will be recovered at the end of the project because working capital can never be consumed. Sum of all the working capital amounts must be 0. So the main thing was T1 and T2. T1, there's an outflow, but in T2, it is an inflow. Now, is it clear to everyone? You can write it in the chat box, please, so that we can proceed further. Clear. So that's great. Okay. When we started, we did discuss one rule that is, by definition, everything must be a cash flow, except the tax depreciation. We know that tax depreciation itself, it is not a cash outflow. But what happens? Due to tax depreciation, actually, we save tax. That is why while calculating NPV, we do consider tax saving from capital allowances. So another name for the tax depreciation is capital allowances. Okay. Now let's do a question. Initial investment, 2,50,000. Residual value is, let's take it 50. Project life is 4 years. Capital allowances or tax depreciation, interchangeable words. Capital allowances are available at the rate 25% written down value. Okay. Tax rate is 30%. paid with a delay of 1 year. Tax rate is 30% paid with a delay of 1 year. Okay. Required. Calculate tax savings from capital allowances. Calculate tax saving from capital allowances, assuming that investment is made at the start of accounting period. The start of accounting period. I would say 99% of the question we have this assumption. If I go towards AFM, so almost 100% we have this assumption that investment is made at the start of accounting period. I really want every one of you just to attempt this question. Then we are going to discuss together as well. Initial investment is 2 lakh 50. Residual value is 50,000. Project life is 4 years. Capital allowances are available at the rate 25% written down value. Taxes paid with a delay of 1 year. And the requirement is very simple. You need to calculate tax saving from capital allowances. So I'm giving you at least 8 to 9 minutes. So every one of you is having around 8 minutes. So please try, and I really need answers. Then we will try together as well. So you have 8 minutes to try. Everyone is having the same answers or the different one? Okay, I think let's try together. Then very soon, inshallah, I'm going to share the question and then we'll start solving the questions as well. Don't worry at all. So all the students are having the same answers. Okay. Time T1, T2, T3, T4. It goes till T5. Why? The reason of going till T5 is even though the project life is 4 years, because we are paying tax with a delay of 1 year. The second column is of capital allowances. Then you have tax saving. Company is using 25% reducing balance method. Look at this, 2,50,000. Can I say into 25%? 250 into 25%. I'm getting 62,500. How did you calculate capital allowance for the second year? Since it's a reducing balance method, look at this. 2,50,000 minus 62,500. Let's see what I'm getting. I'm getting 1,87,500. Let's take 25% of this. I'm getting 46,875. What I did, cost minus the capital allowance, net book value, then 25%, I got this. Look at this. If I take 62,500 here, I multiply this with 75%. Let's see what are we getting. We get the same result. Can you check, please? I'm getting 46,875. Is this clear to everyone? You're getting the same result. Cost minus the depreciation net book value into 25%. And look at this. If you are using 25% reducing balance method, then for the second year, you have to take 75%. If instead of 25, it was 20, then instead of 75, I would have multiplied with 80. Now, what about third year? 46875 into 75%. I'm getting 35,156. Extremely important point is the last year. That how do we calculate capital allowance in the last year? Project is having a life of 4 years. So in the last year, whenever capital allowances are available on the basis of reducing balance method, in the last year, dear students, you have to take the balancing figure. Always take the balancing figure. In exam, also write the balancing figure. How do we calculate balancing figure? Why do we calculate balancing figure? I'll come to this. Okay. Now listen. There's one IAS. The name of the IAS is Property Plan and Equipment, IAS 16. It is written in IAS 16 that only depreciable cost should be depreciated over the useful life of the asset. Repeat, it is written in IAS 16. Only depreciable cost should be depreciated over the useful life of the asset. Depreciable cost means cost minus the scrap value. Cost of this asset is 2,50,000. Scrap value is 50,000. Scrap value is 50. Okay, students are coming. That's great. Scrap value is 50, which means the depreciable cost is 200,000. So within the useful life of the asset, only depreciable cost should be depreciated, which is 200,000. Now what to do? From this 200,000, just deduct all these three values. You will get the balancing figure. 200,000 minus 62,500 minus 46,875 minus 35,156. I'm getting 55,469. Okay. Tax rate is 30%. Since we are paying tax with a delay of 1 year, so first tax saving will arise in T2, not T1. 62,500 into 30%. 18,750. So there's a question. That's great. Students are having the more or less same answer, in fact. 46,875 into 30%. 14,063. This is 633. 3 wasn't looking 633. 35,156 into 30%. I'm getting 10,547. 55,469 into 30%. 16,641. I hope the majority was having the right answer. I strongly believe. Let me check. Ah, yes, that's nice. The majority was having the right answer, I believe. No, I don't need this. That's simply nice. Great. Okay. Now, part B of the same question. Part B, let me reduce the internet users. No, 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 no. Please, rounding off little bit. Don't worry. Don't consider these things at all. They're not important. Whoever is going to check your paper, they will look at your approach. You are logically correct, you will get marks. They will not be checking your paper like this. If my answer is 16.332, why did you get 16.334? No, no, no. Don't worry about this, please. Rounding off will not create any problem. Okay, part B of the same question. I want you to recalculate tax saving. Everything is same, only the difference is revised capital allowances calculation of year two. I showed you the shortcut. Look at this. This is the normal way of calculating cost minus the capital allowance. This is the net book value, what we do in accounting. Then multiply with the 25%, you will get this. We're getting the same result. Look at this. Simple shortcut. As I mentioned earlier, we love maths. Is it clear? By using this shortcut, you're getting the same result. Now the question is same, but I just want to change. Now the part B, which is rarely examinable, rarely. I've seen only one MCQs on this area, but still, let's do it. Since we are doing I would say the most comprehensive crash course, inshallah. So let's cover that little area as well. Everything is same, except assuming investment is made at the end of accounting period. I want every one of you to recalculate tax saving from capital allowances. The data, tax rate, reducing balance method, everything is same. Only one change. Now examiner is asking us to assume that investment is made at the end of accounting period. So please, you have 3 to 4 minutes. Please reattempt the question by using this assumption, which I have just written. So I'm here. Okay. So if results are there, we can start. Should we start? Okay, I think should we start? Students, can you share your answer, please? Students, if you can share your answers. You can share your answers if you have calculated. Okay, here comes the answers. Tax saving, one student is 33. No, 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 no. No. What about others? Don't worry, we'll be discussing inshallah each and everything. All you need is give me time, okay? Show patience. We are here. And I'll make sure that this crash course will be remembered for a longer period of time, inshallah, in your life. I'll discuss. Actually, I'm saying it's the same question. And right now you're making investment at the end of accounting period. Let's say, let me tell you the difference. Look at this. Assuming the investment is made at the start of accounting period. Look at this. Assuming the accounting period of this company starts from 1/1/2024, goes till December 24. So over here, you in first requirement, you made an investment over here. This is the time of investment. So Kalimullah, you have to mention the timings as well. You did not mention the timings. When will the first tax saving will come and when the second? In the second requirement, in the second assumption, the accounting period is same and you are making investment on this date. Is it clear? Now the question is clear? No, 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 no. Okay, now listen. Now please. The second assumption rarely comes in exam. It's very simple. Don't panic at all. Now try to understand. Whenever the examiner says it is categorically if mentioned that you are making investment at the end of accounting period, what difference will it make? We are making investment on this date. Project is having a life of 4 years. Whenever you are making investment at the end of accounting period, always start your tax saving calculation from T0. Just start from T0. Why T0? I'll tell you. Then T1, T2, T3, T4, and then I'll go for till T5. Why T5? Because we are paying tax with a delay of 1 year. Why did I started this calculation from T0? Look at this. Actually, you are making an investment at the end of accounting period, which means that profit and loss is already prepared. Profit and loss is already prepared. All you need is just calculate the tax depreciation and show that tax depreciation into that P&L because P&L is already prepared. So you can immediately claim the capital allowance. Since for claiming the capital allowance, you have to have the profit and loss. If you don't have the profit and loss, you cannot claim tax depreciation. You cannot claim capital allowances. Since you are making investment at the end of accounting period, so logically, profit and loss is already prepared. There's no need to wait for claiming the capital allowances. Just calculate the capital allowance and simply show it to the P&L. That is why you will always start from T0. And I'll come to the first one also. Why did we started over here at T1? Just a minute. Capital allowances. And these timing one, when you are making investment at the start of the year, when you are making investment at the end of the year, this is extremely important in another topic, which is lease or buy. Extremely important. So we'll be discussing this area again in more detail at that time, but I'm going to discuss this again also. Don't worry. I'm repeating it. I'm repeating it. Just wait. So 2,50,000 into 25%. Let me first calculate, then I'll show the difference between two assumptions. That would make the life easier, inshallah. 2,50,000 into 25. Then you can easily compare both the things. Take 75% of this. 46,875. $35,156. Again, the last year. T4 is the last year, so you have to take the balancing figure. How do we calculate balancing figure? The same thing. Cost minus residual value. Something went wrong with the internet. I don't know what. The recording is still happening. Okay. Okay, fine. So cost minus residual value. Depreciable cost is 200,000. Let's take the balancing figure. From 200,000, we need to deduct all these capital allowances. Minus 62,500 minus 46,875 minus 35,156 minus 26,367. I'm getting 29,102. That's great. Now, tax saving. 30%. T0 tax saving will arise at T1 because we are paying tax with a delay of 1 year. 18,750. 46,875 into 30%. 35,156 into 30%. Okay. What is the answer? T4, I'll come to that, please. 26367. $29,102. Okay, now let's quickly discuss what is the difference in second assumption and the first assumption. But before that, how did I calculate the last value? Balancing figure. Let me change the color. This is the depreciable cost. What I did, I deducted all these values. 62,500, 46,875, 35,156, 26,367. So I got this balancing figure 29,102. So that depreciable cost should be depreciated within the useful life of the asset. That is why in the last year you have to take balancing figure whenever you have been asked to calculate tax saving from capital allowances by using reducing balance method. Now, if students please try to understand. This is the accounting period of any company. It could be XYZ company. If you are making investment at the start of accounting period, please try to understand. This will really help you, especially in lease or buy decision as well. If you are making investment at the start of accounting period, start of accounting period. Let's say you have made an investment of 2,50,000. If I take because there's a delay of 1 year, Kalimullah, T4 tax saving will arise in T5 because T4 tax will be paid in T5. Is that clear? Because there's a delay of 1 year. It is written in the question. That is why T4 saving will arise in T5. Clear? Yes, no? Be quick, please. Because it says there's a delay of 1 year. Okay. Start of accounting period. Let's say you have made an investment of 2 lakh. If you are paying tax with a delay of 1 year, so T1 tax will you pay in T2 or T1? If you are paying tax with a delay of 1 year, what does it means? T1 tax will come in T2. Then what about T2 tax will come in T3? Then T4 tax will come in T5. Similarly, the T4 tax saving will arise in T5 because of the delay of 1 year. Is it clear? Because you are paying tax with a delay of 1 year. Okay. Let's say if you're making investment at the start of accounting period, your investment is 250. If I take 25% of this, I'm getting tax depreciation. Another name is capital allowance, which is 62,500. You have calculated 62,500, but normally what happens? If I go back to little bit towards FR or even the taxation, what do? We take accounting profit. Logically, we add back the accounting depreciation and we deduct the tax depreciation. But please, accounting profit of 2024, you will get to know when? On December 2024, exactly after 1 year, because you are making investment on this date. But your P&L will be prepared after 1 year. So logically, even you have calculated the tax depreciation, but still you have to wait for the accounting profit and loss to be prepared. How much you have to wait? 1 year. That is why whenever you are making investment at the start of accounting period, tax saving from capital allowances will always start from T0 or T1. Always start from T1. Look at this. In the example number 1, in the first assumption, we started from T1. Because it says assuming investment is made at the start of accounting period. But if the question says you are making investment at the end of accounting period, it means the P&L is already prepared. So whatever tax appreciation you have calculated, you can claim that into the P&L. So there's no need to wait for the P&L. So simply when you are making investment at the end of accounting period, then there's no need to wait for the P&L. And if I make it more easier, okay, that will help you a lot. You have made an investment on this date and you are paying the tax with a delay of 1 year. So now my question is, 2024 tax will be paid on 2025 or 2024? Just tell me quickly, please. If you are paying tax with a delay of 1 year. 2024 tax will be paid on 2025 or 2024? Just tell me quickly, please. If you are paying tax with a delay of 1 year. If you are paying tax with a delay of 1 year, So we'll be paying 2024 tax in 2024 or 2025. Let's say the examiner says the tax will be paid on December of each year. 25, good. Tax will be paid on December, on 31st December of each year. Now my question is, from the date of investment, first tax payment, how much is the delay? How much time it will take? Can I say 2 years? Yes or no? If you're making investment on 1st January 2024, examiner says tax will be paid on with a delay of 1 year. So let's say you'll be paying tax 2 year. Great. Now listen, if you're making investment on this date, December 2024, you're making investment. And tax is paid with a delay of 1 year. You're making investment in 24, December 24. Can I say December 24 tax will be paid on December 25? So how much is the delay from December 24 till December 25? Can I say the delay is 1 year? Is it clear now? So look at this. When we made an investment at the end of the accounting period, so first tax saving came in T1. When we made an investment at the start of accounting period, so first tax saving came in T2. So I've tried to give you the reason as well. Otherwise, you just need to remember if you are having, you should not be having issue at all. Reason I have given. I hope it is clear now. Otherwise, most of the time in exam, I would say around 99%, there's only one assumption being examined, that is investment. I would say there are 99, almost 100% chances that investment will be at the start of accounting period. So you will always be starting your calculation from T1. Dear student, is it clear to everyone? Just tell me so that I can share the question with you. Let me see. I should be having a question. There should be a question. Many messages. Is it clear? Should I share the question? Please be quick. Then I have to take prayers break as well. Uh, I'll give you the break also. Don't worry at all. Okay. Let me share the question in your WhatsApp group also. Dear student, I've shared one question in your WhatsApp group. I'm bringing that question on the screen as well, so that you can read it nicely and attempt the question. Then obviously we'll be discussing together also, inshallah. And I'll show you all the shortcuts which are available in financial management, but only those shortcuts which are available. Obviously, the shortcut which is not available, there's no point of discussing that. Let me save this page first. And I'll be sharing these slides with you also. It's a first handout, I would say. Just a minute. Investment appraisal, crash, March 24, part 1. I've saved that. Let me share the question on the screen. Screen. Just a minute, what is happening? Let me share this. I hope I should be having the email of the question. Yes, it's here. Mhm. I hope that everyone can see the question. Let me little bit zoom out so that little bit more so that you can see the whole data. Our requirement is very simple. You just need to calculate NPV. This is the data. Just quickly, please reply. Everyone can see the entire screen. Be quick, please. You can write in the chat box. Not receive on WhatsApp. No, I have shared in the crash. Otherwise, I'm going to share other WhatsApp group as well. Don't worry at all. But can everyone see on the screen? Yes, no, please. Yes, you people can see. So I really want every one of you try to attempt this question. And those they are having asr time or any namaz time, you can take the break as well. I'll be back inshallah within 20 minutes, 20 to 22 minutes. Okay. But I really want those they are not going anywhere. Please try to attempt this question because you need to attempt unseen questions as well. So please attempt. So we'll discuss. I'll be back inshallah within 20 minutes. I'll stay. Okay, dear students, thank you very much for the patience. Let's start. I hope is there anyone who has tried this question? Any answer, or should we just start? Those they were there, they should have tried, I believe. All right, let's see what are the results. On the way to complete, that's great. What about others? Okay, let's try together now. It's a really, really good question. And then we'll move to another technique. Then don't worry, we'll be doing investment appraisal question on spreadsheet as well, so that you should be having the idea. Obviously, you'll be having idea, but better that to solve some of the question on Excel as well, spreadsheet. The requirement is very simple. At least nobody can say that he or she that did not understand. The requirement is very simple. Just calculate NPV. That's it. Let's try to understand the story. Story is very important. If you can understand the story, then the job is done. Okay, ASA Nelson, what we did, we took the name of some Gora people with us. ASA Nelson manufactures and fit a variety of children's playground equipment. The company at present purchases the rubber particles used in a playground surfacing from an outside supplier. Uh, they are manufacturing variety of children's playground equipment. For that, they are purchasing rubber particle from outside the supplier. Okay. But is considering investing in equipment which would process and shade used vehicle tires to produce equivalent rubber particles. Now, AAC is thinking instead of buying from the supplier those rubber particles, why not? We should make an investment in the equipment which will use the used tires to produce the same rubber particle. Okay. 1 ton of purchased particles is saved per ton of tire process. Wow, the ratio is 1:1. It means ASA is going to process 1 ton of tire, so they will not be buying 1 ton of rubber particles from the outside supplier. Disposal of used tires is becoming an environmental problem. Okay. And ASA believes that it could charge £40 per ton to garage tire distributors wishing to dispose of their old tires. Now listen and listen carefully. To manufacture rubber particles, ASA needs used tires. And ASA is saying that we are not going to take only the tires from the tire distributors. ASA is saying we will also charge them. It means the raw material will be coming to the organization. Along with the raw material, you will be charging them. Means you will be getting the cash inflow as well. Now the question arises, if somebody is giving me the old tires, used tires, then why would they will give us the cash also? There's a reason. Let's see, what is the reason why ASA is so confident that we will be getting the raw material as well as the price, and ASA will be charging £40 per ton. Okay. This price would be 20% lower than the cost of landfill site currently being used. And so ASA Nelson believes that it would face no risk or shortage of supply. What would be a key raw material for the business? Now listen, if the tire distributors are not going to give used tires along with the £40 per ton to ASA, then what do they have to do? They have to properly landfill, properly dispose of the tire. So simply the cost for the tire distributor disposing of the old tires is expensive. Then what AS is asking? So giving old tires, used tires to ASA and giving £40 per ton to ASA is cheaper for the tires distributor. That is why ASA says we will have no shortage of raw material. So it's a very important concept. The raw material is coming, but along with the raw material, there is no cash outflow. Actually, there's a cash inflow. And the reason examiner has given us why ASA will be getting money also. Is this clear to everyone? Why tire distributor will paying us £40 per ton? If they're not paying us, then what do they have to do? They have to landfill. Land filling those used tires or disposing of those tires is expensive for them as compared to what ASA is asking. Is this clear to everyone so that we can proceed? That raw material will be coming to ASA along with they will be getting the cash as well. Please, you can write in the chat box. This point is clear. I just said one thing, that ASA will be getting the used tires from the tire distributors. Along with that, they will be charging the tire distributors. Means ASA will be getting the raw material as well as the cash inflows. Now the question arises, if someone is giving me the raw material, why would they give us money also? The reason is, if the tire distributors, they're not going to give us £40 per ton, then the tire distributors, they have to landfill those used tires. And the cost of the cost of disposing old tires is expensive than what ASA is asking. That is why ASA believes that we will not be having any shortage of raw material. So raw material is coming along with that. £40 per ton, there is a cash inflow also. Okay. The price charged by ASA for the tire disposal, £40 remains fixed for the next 5 years. So £40 per ton will remain £40. It will not change. The cost to ASA of purchase particle is 3.5 per ton for each of the next 5 years, and the price has been contractually guaranteed. Now listen. Before making an investment in the equipment which will use the old tires to produce the same rubber particles, you are already having an agreement with the supplier, which is charging you 3.5 pound per ton for the rubber particles. It means that if you will start producing the same rubber particles, then you are not going to buy from the supplier. If I start producing the same rubber particles, which I was buying from the supplier, it means once I will start producing the same rubber particles, I'm not going to buy them from the suppliers. If you are not going to buy them from the supplier, so there is going to be a relevant saving. Is that clear? If you start producing the same rubber particles which you are purchasing from the suppliers, so you're going to save the money as well. How much you will be saving? 3.5 per ton. But there is a gift also. What is a gift? If the contract is terminated within the next 2 years, ASA Nelson will be charged an immediate termination penalty 1 lakh, which will not be allowed as a tax deductible expense. So supplier has given you the guaranteed price of 3.5 per ton. Along with that, there is one clause also, which says that if you are going towards breach of contract in the next 2 years, then you have to bear penalty of 1 lakh. And that penalty is not tax deductible. It means due to this penalty, you will not be saving tax. Now, my question is, number one, obviously, this penalty is relevant because if entity is going to bear this penalty, this will be because of the project. Because of this project, we will bear this penalty of 1 lakh. Now, my question is, where will you show this penalty? Okay, my question is, when the breach will occur? What will be the time of breach? Please, can anyone tell me? Can I say as soon as you are going to make investment, there is going to be a breach? Logically, the breach will occur at time 0. Why? Because the moment ASA will start producing the same rubber particles, they are not going to buy from the supplier. Repeat, the moment they are going to make investment, they will start producing the same rubber particles. They are not going to buy from the supplier. It means the penalty will be at time 0. Yes, at the start of the project. So deliberately examiner has written T2 that after 2 years, within the 2 years, if you there's a breach of contract, you will be bearing penalty of 1 lakh. So actually, the point of breach is the point of investment. So it is like, let's say uh, your country is normally going towards the import of material X. Now your country has decided, no, instead of going for the import of material X, why not we start producing it? So obviously, the moment you will start producing it, you are not going to import the raw material X. So penalty will be at time 0. Very much relevant because if it happens, it will happen because of the project. The machine required the process of tire will cost 1.06 million, means if I ignore 30, it will be 1060. And it is estimated that at the end of year 5, machine will have a second hand value 1 lakh 20 before the selling cost is 15. So it means scrap value will be 1 lakh 15,000. Scrap value will not be 120. The definition of the scrap value is sale proceed minus cost to sell. They have given you the cost to sell over here. It means if examiner says tax depreciation is available by using reducing balance method, then in the last year you have to calculate balancing figure. So for calculating balancing figure, please, your residual value, scrap value is not 120, it is 115. Sale of the playground surfacing, which uses rubber particles, are forecast to be 1.2 million pound in year 1. In the first year, the sale is going to be 1.2 million, rising by 10% per year until year 5, but the prices will remain constant. Okay, stop. Number 1, can I say if prices are constant, but still the sale is increasing? The reason is increase in sales volume. Repeat. If prices are constant, but the examiner says still sale will keep increasing. Can I say the reason is increase in the sales volume? Is this clear to everyone? If the prices remain same, but still the sale is increasing, the reason is one thing. The name of the reason is increase in sales volume. Is this clear to everyone? You can write in the chat box. If the prices are constant, still the sale is increasing, it means it is just because of increase in the sales volume. Okay. Now I have a question. Please listen and listen carefully. My question is, in the first year, the sale will be 1.2 million and then it will rise by 10% per year. My question is this sale relevant or irrelevant? Please answer. Is this sale of 1.2 million, which will rise by 10% every year, is it relevant or irrelevant? One student says relevant. Obviously, there's going to be one answer out of two. Another two students are saying relevant. What about others? Okay, let me change the color of the page and let me tell you. Please look at this. The sales amount of 1.2 million is irrelevant. Now the question is, sir, why it is irrelevant? They are saying in the first year it will be 1.2 million, then it will keep rising by 10%. Let's read what is written. Let me remove the red one. Why sale is irrelevant? Sales of the playground surfacing, which uses rubber particles, are forecast to be 1.2 million in the first year. They're saying sale of playground surfacing which uses rubber particles forecast to be 1.2 million. Can I say your final product is same? Either ASA buys the rubber particles from the supplier, outside supplier, or ASA invests in an equipment which produces the same rubber particles. Can I say the final product is not changing? The final product is same. So it means either we are producing the rubber particles or we are purchasing rubber particles to make the same final product. There is no difference on the final product. Your final product is same. If I give you an example, a very basic example, assuming, let's say there's a milk shop in your colony. There's a milk shop in your colony and they are selling the milk. And there's a particular demand in that colony. Okay. Now, nobody knows that particular milk shop owner, what he does, he buys the milk from a supplier, then he sells in a colony. He buys the milk from a supplier, then he sells in a colony. But nobody knows that. Everybody needs the milk. It is available from that shop. Now, after 1 year or after 2 years, that owner decided, let's do one thing. Instead of buying the milk from the supplier, why not? To start his own cattle farm. In that way, there will be no need to buy the milk from a supplier. It means they will be having their own production of the milk. They will be having their own cattle farm. Can I say either the milk owner is getting the milk from his cattle farm or getting from the supplier? The final product is same. Nobody knows that. The final product is same. There is no impact on the final product. So can I say your sale will remain same? Yes or no? And nothing is written like that. Because of make ASA is producing the rubber particle, sale would increase. They're saying the same final product which uses the rubber particle, sale will be 1.2 million. Is this clear to everyone now? Why this sale is irrelevant? Because the final product is not changing. Or should I give you one more example? Be quick, please. Let me reduce the internet users. If I give you another example, let's say, let's take an example of Kaplan books. Let's say In country Y, every year 10,000 Kaplan books are being sold. How many? 10,000. Okay, there's a shopkeeper. Yeah, product has nothing to do with the product. Yes. Actually, sales volume is relevant. Sales volume is relevant, but sale itself is irrelevant. Where we are going to use sales volume, I'll let you know. Just one point, then we'll come, one more example, and then we'll start. Let's say there's a shop Y in XYZ country. Yes. Actually, rising the sale does not depend on the new investment. Rising the sale will be there. Okay, in XY, there's a country Y in which there's one shop and that shop sells every year Kaplan books only 10,000. The demand, let's say, remains 10,000. And assuming what that shop does, it imports those books from UK, then they sell in their country. But the demand remains 10,000. Can I say now instead of going towards import from UK, then sell in the country Y, if they start publishing it, can I say the demand will remain still 10,000? There will be no impact on the demand. Because your final product is same, that Kaplan books, BPB books. So I hope now it should be clear that why the sale is irrelevant. Because they're saying sale of playground surfacing which uses rubber particles are forecast to be 1.2 million. Rising by 10%, this is very much relevant for us. How? We'll come to that. Now look at this. The new equipment will result in ASA incurring additional maintenance cost 43,000 per year. Now listen and listen carefully. Additional fixed cost, incremental fixed cost is always relevant. So this 43,000 is relevant. Look at what is written. The new equipment will result in ASA incurring additional maintenance cost. So very much relevant. 80,000 tons of tires need to be processed in order to meet the raw material requirement for the forecast sale in year one. So in the first year, 80,000 tons will be processed. Can I say in the second year, volume will rise by 10%? Because it is written in the question that prices are same, but still sale will rise by 10%. When prices are constant and sale still increases by 10%, it means the volume is increasing. So in the first year, we'll be processing 80,000, but in the second year, volume will rise by 10%. Processing costs are estimated 37 pound per ton, very much relevant. Why? Because before without investing in equipment, we will not be bearing this processing cost. Tire processing cost will only be incurred when ASA is going to make an investment. Excluding additional appreciation and maintenance, this 37 does not have the impact of any additional appreciation. It does not have the impact of any additional maintenance cost. But if examiner says, let's say 37 is having the impact of additional maintenance of, let's say, 2 pound per ton, then instead of working on 37, you will be working on 35. Why? Because additional maintenance cost per year, 43,000, we are taking it separately. If I'm taking 43,000 additional maintenance costs separately, an examiner says that, let's say, 2 or 3 pound is already is added to the processing cost also, then I have to exclude that additional maintenance cost from the processing cost because we're taking separately the additional cost. ASA is subject to corporation tax 33%, payable 1 in arrears. Capital allowances 25%. Reducing balance method. ASA has sufficient profit to fully utilize the available capital allowances. Now let us start the working. Working number 1 is, let us first calculate tax saving from capital allowances. Taxes are paid with a delay of 1 year. And nothing is mentioned. We will always assume that investment is made at the start of accounting period. And the life of the project. Life of the project is 5 years. The life is 5. Can I say the tax saving impact will go till T6? Why? Because of the delay of 1 year. So let's go for working one. So you can say a little bit different type of question. Just a minute. Realistic. Let's calculate tax saving from capital losses. Tax saving from T1, T2, T3. T1, T2, T3, T4, T5, and T6. Okay. Second column is of capital allowance. Taxing. I'm ignoring 3 zeros for the sake of simplicity. So your initial investment is 1060. Let's take 25% of this. 1060 into 25%. I'm getting 265. 265 into 75%. 199 with a little bit rounding off. 199 into 75%. 149. 149 into 75%. 112. Last year, we'll take the balancing figure. Cost is 1060 minus the scrap value, which is 115. I'm getting 945. Let's take the balancing figure. 945 minus 265 minus 199 minus 149 minus 112. That is 220. What is the tax rate? 33%. T1 saving will arise in T2 because of the delay of 1 year. Two 65 into 33. I'm getting 87.45, so make it 87. 199 to 33. 66. Little bit rounding off. There's no issue at all. 149, 33, 49. 37. 220 into 33. 73. I hope that everyone is having the same values. Working two is more important. Working two is extremely important. If you can understand the working two, the job is done. Seriously, working two. It's very easy. Just concentrate, just focus. Time. Revenue is 40 pound per ton. We are getting, they have written, they have mentioned, where is this? 40 per ton. Yeah, we'll take the volume also. Revenue is 40 per ton. Then If you're processing 1 ton, you'll be saving 1 ton. If you're processing 1 ton, you'll be saving 1 ton. So saving is 3.5 per ton. But you have to bear the processing cost also. You have to bear the processing cost, which is 37 per ton. Okay. Now, T1, T2, T3, T4, and T5. We're ignoring actually 3 zeros. In the first year, you will be processing 80 tons. So 80 tons into 40 will give you the revenue of 3,200. But in the second year, since the question says selling price will remain fixed, but still the sale will rise by 10%. It means sale volume will increase. Which means in the second year, we'll be processing 80 into 1.1. Or you can do one more thing. 3,200 multiplied by 1.1 will give you the same result. I'm getting 3,520. I hope this calculation is clear to everyone. Because it was mentioned in the question that ASA will be getting the raw material. Along with that, they will be charging 40 pounds per ton to the garage tire distributors. Four two five nine. So please, you people also keep solving it so that there should not be any mathematical error. 4685. If this revenue calculation is clear to everyone, now instead of 40, you need to multiply with 3.5. So we'll get the result. 80 multiplied by 3.5. I'm getting 280. Then simply increase this 280 by 10%. 280 multiplied by 1.1. I'm getting 308. 339. 373. 410. Now, instead of 40 for calculating processing cost, which is an outflow, you need to just multiply with 37. 80 into 37, it gives you the cost of 2960. Then simply 1.1, I'm getting 3256. 3582. 3940. Is this calculation clear to everyone? Please give the feedback in the chat box. Is this clear to everyone? So that we can proceed further. Is this calculation clear? Please, you can write in the chat box. Waiting, student, I'm just waiting. Or if you have any question, you can ask. Okay, let's see. It is clear. Why have you increased the figure by 1.1? It is mentioned in the question that sale volume is rising by 10%. Kalimullah, it is mentioned in the question that sales volume will rise by 10%. So that is why I have multiplied this 1. Obviously, the volume rises by 10%, so you have to multiply with 1.1. Then it has to be square. Is this clear? Processing cost. Basically, when you are going to process the used tires, so you have to bear the processing cost. And it is 37 per ton. So just you use the calculator, 80 multiplied by 37, you will get this. and then simply increase that with 10%. Just multiply T1 processing cost with 1.1, you will get T2. Why? Because the sales volume is increasing by 10%. Otherwise, please listen. 80 multiplied by 1.1, whatever comes, then multiply that with 37. You will get the same result. 80 into 1.1 square, multiply by the 37, you will get the same result. So, student, please now. It is clear. I think we should go ahead now. Now let's calculate NPV. Or we can do this, but again, when we have to come again and again. Time, T0. We have the value, so I think we can calculate NPV on Excel. What do you say? Should I calculate on this one node or should I go to Excel? Please be quick. Should we calculate here or should I go to Excel? Please, you can give your feedback. Excel is quick, but we have to get come again and again. Okay, let's try on Excel. Let's go to Excel. Okay. But then at least I need one person who should be telling the values. Let me share this Excel sheet first. Okay, we are calculating NPV. Time is 0, 1, 2, 3, 4, 5, and 6. I'm just ignoring 3 zeros. Initial investment. Initial investment is minus 1060. Now let's take the revenue. Can anyone tell us the values? Otherwise, we have to go back. Let's go back to the revenue values. Revenue is here. 3,200. Okay. Okay, please, if you people can keep telling us so it becomes quick. Revenue is 3,200. Then I can do this also if we don't have to go back. 1.1. Hmm, 1.1. Is there any answer? What did you miss? Can you please tell? Then I'll repeat it. Revenue is clear to everyone? Actually, it's just a copy paste. But since we have solved on the one note, so we are going back. Revenue is an inflow, obviously. Processing cost, I said that you have to bear the processing cost because when you are making investment in this equipment, which was not there before, so you have to bear the processing cost, which is a relevant outflow. Because earlier you were not processing these rubber particles. Now you are going to process these rubber particles, so you have to bear the processing cost. That is why it is relevant. Is it clear now? Okay. Saving. Can anyone tell me the first saving answer so that I'll keep increasing that with 10. What was this first answer in the saving? 280. Thank you. The first answer was 280. I need please processing cost. Can you tell me the processing cost of first year? Can anyone tell me? The processing cost of the first year. 2960, Jazakallah, 2960. Where I've written this 2960. 2960. Okay, just take this 1.1. Okay, multiply this 1.1. Then this multiply 1.1. There's additional maintenance cost, I think 43,000, very much relevant. Additional maintenance cost, which is very much relevant. Every year we'll be having same, so the option of drag now we can use. We have taken revenue, we have taken savings, processing costs, we have taken the additional maintenance cost as well. Is there any other cash flow which is left, or we have taken all? Tax saving from capital allowances will come after the tax payment. Scrap value will come after the tax payment also. If we go back to the question, just a minute. I think we have taken all the cash flows. Yes, no? Penalty will show in the time 0 and penalty will not result in tax saving. So taxable profit. We can use the sum formula which is available in exam. Tax rate is 33%. Tax payment at 33%. Start from the second year with a negative sign because we are paying the tax. Let's see, the option of drag should work. It will go till T6 because T5 payment will be in T6. Now you can take, let's say, take the penalty. Can I say the outflow of the penalty will be at T0? Tax savings from capital allowances. You have to give the working, I think it came from T2. What was the first saving? We have to go back. Let me go back. Tax saving, first tax saving is 87. Okay. 87. After that, next is 66. Great. Then 49. Then 37. Great. Then 73. Great. Scrap value will be 115. I think all the cash flows we have taken. Let's calculate the net cash flows. At T0, it will be this plus this. Now, let's use the sum formula, but make sure how you'll be using the sum formula. I'm considering this cell, then tax saving from capital allowances. I'm taking, okay, this one also. Tax payment also, and you have to stop at taxable profit. You cannot go over and above taxable profit because till taxable profit, you have already used the sum formula. Now the option of the drag will work definitely. Cost of capital is 12% if I'm not wrong. Cost of capital is 12%. NPV instead of writing NPV of cash flows. You can say just a minute. Present value of cash flows from T1 till T6. How do we calculate this? Very simple. NPV. And this shortcut of NPV is again available in exams. You have to take cash flows from T1 till T6. Now simply deduct less. Can I say we need to deduct this? Here comes your final NPV. NPV. What is the NPV? Let's see. I'm getting the NPV 581.36. Is this clear to everyone? We're getting the NPV of working of present value. Let me is change. I think in the question they use the pound sterling. Please use this formula. First, I calculated present value from T1 till T6. It came 1741.36. Then I deducted 1160. So the final NPV is positive 581.36. I'm using only those shortcuts which are available in exam. And this is available in exam. Is this clear to everyone? I hope you people are practicing like that. Yes or no, please quickly respond. Because we have 3 to 4 minutes, then there will be a break of 15 to 20 minutes. Okay, let's see what is the answer. Don't click on present value. Should I, so what should I do? Double click. Can you see this? Okay, this is the double click. Can you see that now? How I calculated present value of cash flows? Okay. Now let's go back to other technique. Let me share the screen. Mm. Okay, dear students. Let's just start another investment appraisal technique, that is IRR. And everybody knows that shortcut of IRR is available? Yes or no? IRR, internal rate of return. Okay, now there's prayer time. So Maghrib prayer time is there. So I'll be back within, it will take around 20 minutes at least, 20 to 25 minutes. Thank you. Thanks a lot. So actually what I'm going to do, I'll just tell you. Otherwise, this video will be very long. So it will become difficult for the team to upload on the YouTube. So I'll reconnect after 25 minutes. Is this okay? So that I can send this video to the IT team so that they should upload the video on YouTube. But after 25 minutes, inshallah, I'll send the message on the group as well. So otherwise the things will become a bit tough for the IT department. So exactly after 25 minutes, inshallah, I'll resume the class and I hope to see you all as well. We'll be starting from IRR and then other investment appraisal techniques. So inshallah, we all are meeting after. Okay, I'll send. Done, done, done. But after 25 minutes, please, you people should come. Okay, thank you.